David Weaver, Megan Wallen, Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm. It's now time for User-Friendly Finance with Dave Weaver from SWC Wealth Management on News Radio, WHP 580. If you have a question for Dave, call 540-0580. Now with today's show, here's Dave Weaver.
Hi, good morning. This is Dave Weaver with SWC Wealth Management, bringing you another issue of User-Friendly Finance. And as we try to go through the various things that could affect your personal financial life. And last week we started to talk about what we call the 8 wealth management issues, which are a way that you can help define your personal financial planning or help create your own personal financial plan and some of the different aspects that come into your financial planning life as you go through life. So we'll recap those in a minute, but just wanted to say that a little more information about SWC Wealth Management. Tom Pop is joining me today from our Carlisle office.
Good morning.
Good morning. How are you today?
Doing well, thanks.
It's the 8 wealth management issues are kind of what helps us define our relationship with our clients. So, Tom, you joined us about 8 months ago. How have you found working with the 8 wealth management issues?
Yeah, it's great. We take a holistic approach to our planning process, and I found that typically through that process, we find that these 8 wealth management issues do impact all of our clients at some point in their life, or at least part of it. So yeah. I think it's important to address all of them.
Yeah, it's not all 8 at one time. It's
never all 8 at one time. But sometimes there's a few, but yeah.
Okay, so SWC Wealth Management, just to give you a little framework, SWC True North Wealth Management, we're in the process of sort of rebranding ourselves just a little bit, keeping our SWC and adding our True North concept that we've been talking about. We're a full-service financial planning firm. We have offices in Palmyra and Carlisle. In Palmyra, we're at 103 West Main Street, about a block off the square. And in Carlisle, we're at 35 East High. Both offices can be reached via our primary number, which is 717-706-0700. We have individual contact numbers on our website. And you can also reach us via the web at swcwealth.com. And the services that we provide are what you would ordinarily find in a financial planning service. And they tie, not directly, but they correlate with the 8 wealth management issues that we're going to be talking about. We do retirement planning with typically we use customized portfolios, but that's retirement and investment planning, estate planning, and college and tax planning. We help people with their 401ks, either evaluate them or look at them for the potential for rollovers. If it makes sense to roll them over, there's a whole list of criteria before it would make sense to do that, but we help you understand that. We have insurance and annuities that includes life insurance, variable annuities, equity index annuities, the whole realm of annuities. And I think one day we'll probably just do a show explaining the different types of annuities because there's a lot of misconception about them. And I think we may have talked about long-term care, but life and long-term care. And sometimes life insurance that includes long-term care aspects. If you have a question as we're going through our show today, can feel free to give us a call at 540-0580 or 800-724-5801. We have our Panera gift cards if you get on the show, and that's a $10 Panera gift card if you call in and get on the show with a question. The subject today, we're going to sort of extend our conversation on the 8 wealth management issues and focusing probably again on investment management, and probably talk more specifically about some of the risk mitigation that's embedded within the 8 wealth management issues. Some of the conversations that we have with our clients as the markets go up and down, sometimes they're more up than down, sometimes more down than up, but it's always a good time to revisit that as part of your review of why you're invested the way that you are. We talked last week about some of the various aspects of investment management, but we'll talk about the area of risk management as it pertains to portfolio management, and as we talk today. So the 8 wealth management issues, Tom, you want to just read through what some of those are?
Sure, yeah.
Go through the list of what they are.
Yeah, we started last week with the first one, investment management, and we'll continue with that today. But investment management is simply means your stocks, bonds, mutual funds, and how those are managed in your portfolio, and how that correlates with your total financial plan. The second wealth management issue that we work a lot with clients is cash flow and debt management, and that's basically coming up with a budget. It's typically the foundation of all of your financial plans, whether it be retirement planning, education planning. Figuring what's going in, what's going out is very important. The third wealth management issue is family risk management or insurance. It's basically insurance planning, long-term care, disability, and life insurance, making sure that you have some sort of insurance lined up, whether it be through your work or through a term policy somewhere else. Fourth one would be retirement planning. This means having a clear picture of what your retirement will look like, and we do a lot of that in our office. I think that's probably a bulk of our planning is retirement planning. Also deal with education planning. That's making sure that you have plans to fund your children's or grandchildren's education. We also talk about legacy planning. That's more along the lines of estate planning, making sure that some people, making sure that you have some sort of setup for, your investments in estate towards the end of your life, and making sure your wishes are carried out. And then business planning, which doesn't typically apply to everyone, but at some point in time, it could make sense for you if you're looking at starting a business or owning a business. Talking about retirement plans, what's appropriate for your business, 401k, simple SEP plans, business insurance, and other items. And then finally, special situations, which comes up whether it's typically if you're making some sort of large purchase. If there's something that's coming up in your life, whether it be a wedding or you're looking at purchasing a second home, these are also issues that we help people address and find ways to plan for. So essentially, that's
that's the list of what we cover.
That's the list of what we cover.
And what we try to do in our practice is, we look at that list when we first engage with people, as we try to figure out which of those areas are most important to them, and as we go through our meetings through the course of a couple of years, we'll maybe cover one of those in each of our meetings. So over the course of a year, if you've met 4 times, you would cover those over 2 years. If you meet 2 times a year, you'd maybe come over 3 or 4 years. It's whatever aspects are important to you at the time. We try to, at this point of the year, make sure that that you've identified what we want to talk about for the current year, and make sure that we address it in at least one of the meetings. Sometimes a specific issue. I'll just take special situations because it's not an easy target, but a lot of times the date for it is out in the future. A wedding is a good example where if you have daughters and they're, in their teens right now, you want to start, even though it seems like it may be a long way away before they get married, you have to make a decision as to whether or not, I'm not sure exactly when the right time to plan it is. It starts to become more relevant as you get closer and closer to that time. But let's say they're in their let's say they're 18, 19, second or third year of college. They start to have a serious boyfriend. You start to think, oh no, they're going to get married. And then you have to decide, particularly for girls, I guess it's, I don't know if that's would be considered sexist to say that, but historically it's the woman's family who has paid the bulk of the wedding price. Yeah. Now it's changing a lot. Sometimes the couples chip in together. Sometimes the couples themselves are paying it. Sometimes the families are paying it. But historically, it's been the woman's family that's done it, and a lot of times the girl's family is a little more involved with the wedding planning. I guess we better take a break there, but only for time, not because I'm uncomfortable with talking about women and weddings. But we'll be back right after the break. This is Dave Weaver and Tom Pop from SWC Wealth Management with User-Friendly Finance. The subject of the 8 wealth management issues always gets me thinking. Anyway, we were talking with someone yesterday just about the subject of weddings, just as back to that example of special needs planning. This is Dave Weaver and Tom Pop from SWC Wealth Management and User-Friendly Finance, talking about our 8 wealth management issues, and we were just sort of got diverted on the subject of special situations which might come into play for someone. But we had one couple, not the couple yesterday, but we had a couple at one point that had, I was telling Tom on the break that the wife wanted a $90,000 wedding for each of their 2 girls, and the husband wanted to give them each $10,000 or $15,000 and let them do whatever they wanted. And if you're going to do either one of those, you have to have money set aside to do it. It just doesn't pop out of nowhere if you haven't planned, particularly a $90,000 wedding. Two $90,000 weddings, that's $180,000 that you would have to come up with at the point in time of the wedding to pay for those. So you have to give some thought to it. And those are one of those things where if you've got one that's coming up in 2 years or 3 years, that may be enough to save up $90,000, and it may not. Depends on your situation. If it's something that you're planning down the road and it's $90,000, you may have to wait. You may have to save 6 or 7 years to make something like that happen.
And that can be difficult to do because you can't necessarily plan a wedding 10 years in advance.
Yeah, you
if you don't.
But you have to. You want to start to create an idea of in your own mind. If you're,
but just setting the
whether
money
your plan
aside.
is big or little for your kids.
Right.
And if it turns out to be, it's easier to spend less money than it is to spend more if you don't have it.
Oh, yeah.
So anyway, in that couple's case, they ended up getting divorced. That wasn't the only reason, but it was a good example of the differences that people have in money. So a lot of times it's better to have these conversations early rather than late. Not so you can get divorced sooner, but because it's just easier to have those discussions. It's better to have them than to not have them.
Oh, yeah.
Because if you get surprised by them down the road and you're like 6 months from the wedding and you're decide that you're going to come up with $90,000, that can be extremely stressful when one of the couple isn't expecting it. So anyway, that was a diversion, but it's just a way that all these financial subjects can become complicated or intense. So one of the things that we've been talking with, particularly lately, it seems like, is when the market's been good for a long while, or if it's been bad for a short period of time, or even a long while, what do you do with your investment portfolio to accommodate volatility? And we talked on this show a lot about the fact that you shouldn't change your overall allocation of investments, particularly the break between stocks and bonds. If you're 60% stock and 40% bonds, and you've gone through a process where you've determined with your financial advisor that that's the right allocation for you, the things that should change that are life events. They're not events in the market. It should be marriage, death, birth of a child, divorce. There's a myriad of things that are events in your life that could trigger retirement, that could trigger you to make a change in how you're invested. It should not be the day-to-day gyrations of the market.
Yeah, I think people forget that volatility is normal in the market.
And it's a long-term. Almost everybody's plan is a long-term plan.
Yeah, and it's a long-term plan.
Yeah, and if you're in your 80s, you still have 10 or 15 years. Hopefully, if you're in good shape at your age in your mid 80s, your life expectancy is probably still into mid 90s,
Mm-hmm.
which means day-to-day fluctuations are important, but they're not the things that should drive you from, in that case, from CDs to cash or whatever your mix is.
Yeah, knee-jerk reactions are never really good, and I think during times of high volatility, it is also important to take a look at your positioning and see am I correctly positioned too.
Yeah, what we tell people, particularly in a period of down volatility, which is one of those things that will happen. Back in 2016, we had the first 11 weeks we dropped 13% in the market, and then again later that year we had Brexit, where for 5 days the market collapsed and then corrected. Both cases, the markets came back relatively quick period of time. But as an example, back in 2016, what we would tell people is, let's see where this market settles down. And it may be a couple days or another week or 2 weeks until it hits that point. Let's keep our focus of staying in balance. So if it's time to rebalance, we'll rebalance. Get us back, if you're a 60-40 allocation or 70% stock, 30% bonds, whatever your allocation, we'll maintain that allocation. But when we get to whatever stability is, because stability will come, it may not be necessarily a flat period, but it could be the volatility will decrease. You'll go to a more sustainable, either slight downturn, slight uprise, but a more stable environment. Like the markets, if they're up 300 or 400 points or 500 points every other day, that's a period of volatility. But if you get a stable period, step back, reassess your portfolio. Is this a period that caused me concern, particularly on the downside, is just did that stability cause me to not sleep at night? Did I get nervous when I woke up in the morning and I had to quick run to check what the market was doing last night? When the markets are going up, nobody has those concerns. Everybody's kind of very satisfied. But you have the same concerns on both sides. But in down periods, people watch it very closely. They're checking their balances every day.
People have a tendency to get complacent when it goes up,
right?
And not really look at their portfolios to make sure that they are balanced correctly. And I think that is also an issue. We typically rebalance quarterly for our portfolios, and that really helps keep that in line as markets go up. So if you had like a 50-50 equities to fixed portion and the market goes up 10% or 20% even, then all of a sudden you're looking at 60-40. Then maybe it's a time to rebalance. And I think that's the important part of asset management. It's an important part of what we do. And just also to just keep in mind, volatility is a normal thing, but the distribution of volatility is not normal. So you'll see it'll be just very low volatility like we've seen over the last couple of years and then spike.
Yeah.
And then go back to normal and then spike. So that distribution is not normal. And if you're not comfortable with what you're in and that really makes you upset, then maybe you're not positioned correctly.
Yeah, for a couple of years we were tracking the VIX, which is a volatility index. That for quite a long period there was at historic lows and is now going crazy as we're seeing the volatility in the markets. But that may be an indication of something to keep an eye on, just to get a feel for volatility. But back to Tom's point, if your allocation, if you have a 60% stock, 40% allocation, you've been through a period of volatility like we went through in those first couple weeks of 16. It made you uncomfortable, made you lose sleep, made you check the markets every day. Then maybe your allocation should be a little more conservative. Whatever you do in terms of decreasing your risk is going to, in the long term, decrease your overall returns. We know that more equity exposure over time historically has given you better return over time, but it also gives you a little more volatility over time. The amount of volatility you're willing to take in your portfolio is in addition to the time frame of when you need the money, that risk you're willing to assume is more of short-term risk than long-term risk, because we know over time that history has demonstrated that equity returns over a long period of time, the more risk you take on, the better your returns. The less risk you take on, the lower your returns. So historically, you can assume more risk than what you might be comfortable with in the short term.
Yeah, and over time or historically, from peak to trough, a correction is around 10% average. But 80% of those years of the time, the market has a positive return.
Right.
Even though it's up and down potentially 10% in any given time.
Right.
Over time, over the last 35 years or so, it's still 80% of the time has been positive.
Yeah. So what that means, and it's hard to keep in the back of your mind sometimes, is 8 out of 10 quarters are positive, right, and 2 out of 10 are negative. Like right now, we're in that period where I think 8 out of the last 10 or 9 out of the last 10 have been positive, one negative quarter, maybe the fourth quarter of 15 or fourth quarter of 16 might have been a little bit negative depending on how you were allocated. But we're a predominantly positive market, or have been in a predominantly positive run. But again, the same rules apply. Keep your allocation in balance, because if you're in a 70% stock portfolio and you've been a little more exposed to the market, you've had a good gain, and all of a sudden you're 85% exposed to the market.
Now you're more risk.
Yeah, now you've got more. Yeah, now you've got more risk than your risk tolerance might indicate that you would be. So you've got to keep an eye on where your portfolio goes. And a lot of people are set it and totally forget it. You can't really do that, because over time the markets are dictating what you're doing, not your overall time horizon risk tolerance for the money that you're trying to invest. So you really want to keep that perspective as we go through both highs and lows in the market. So we'll take a break, and then as soon as we come back from the break, we'll take our call from Jack. Hi, this is Dave Weaver and Tom Pop from SWC Wealth Management and User Friendly Finance. We're talking a little bit about the subject of risk management, and We have a call that we were not able to get before the break, so we'll go to Jack and Hershey. Hey, Jack, how are you today?
Good morning, and thank you for taking my call.
Sure.
Dave, I'm interested in how do you handle a client, a prospective client, that's concerned about putting all their money in one bucket, if you would say. In other words, not in one investment, but with one investor. I'll call it the Bernie Madoff frightening scare.
Yeah. It's funny. For whatever reason, I was watching 3 episodes last night of American Greed, and one of them was called the Mormon Madoff, because it was a guy who was like Bernie Madoff, who was charismatic, convinced people to invest their money, and eventually it was really just a Ponzi scheme. He was using the money that was coming in to fund other people. And what's hard for me is I never really understood exactly how Bernie Madoff pulled it off. With the guy that they showed last night, it seemed like it was easier. You could, even then, it's very difficult to pull something like that off. You have to create statements. They're coming basically typed from or printed out from a computer printout that looks like it would be a legitimate statement of your account. And Bernie Madoff was doing the same thing, generating statements that were showing people's investments going up. And I think what finally caught up with the person in Utah was that 08 and 09 hit, and all the statements that his clients were getting were showing his investments going up by 10 or 12% when the Dow and S&P at the time were going, in total ended up going down 40%, but their investments kept going up by 12%. There was nothing, in 08 and 09, there was nothing going up. Bonds were down. Everything was down. All the equity classes were down. All the bond classes were down. I think I'll start by saying I think that in my perspective, from my view, I think it's difficult for people to have more than one advisor. I'll just start from that perspective, because I think that I think if you do that, and let's say you have two advisors, and you give one $20,000, the other $20,000, and say, we're going to see in a year who does the best. And in our world, that's not the way we like to see people plan. You should have one plan, all your pieces working together. You may be able to have somebody that's, working one piece of it within the framework of a whole. But I think if you have two people that are competing for your perspective, different asset classes do better at different times. Different types of investments do differently. Bonds do differently than equities. Equities do differently than variable annuities. Everything has a different performance, and you want one plan that you're working towards that gives you the plan that supports all your financial goals. So I think it's difficult to have more than one financial advisor, and we've had people come in and had like 3 or 4 advisors, each doing something different, nobody knowing their overall plan. And I just, we don't work with that because I think it causes too much conflict in the person. Each one of those advisors is trying to convince you that they're better or smarter than the other one, or that they know the answers that the other ones don't, and, bring your money to me. I think you're in the big picture, you're better off finding one person that you're comfortable with that can handle your finances. With that being said, that does lead into your question about how do you trust the person that you're dealing with. I think you talk to a couple different people when you try to figure out who your financial advisor is going to be. In our case, you get voluminous amounts of information from the investment companies. You're pretty much forced to have documentation of every investment that you do, and I think it'd be almost impossible to pull off. Like a couple of years ago in Hummelstown, we had that attorney that was taking people's money and said he was investing in a jumbo CD, printing off statements, or typing up statements, or creating statements that showed a small, and a certain amount of gain every year. In our case, you're getting so much information. It's not possible that we could ever create it. Tom, you look like you want to add to that.
Well, I would say that do your research on the advisor and see who they're working, how they're registered, how they're licensed, who their broker dealer is, and then the other thing is that some advisors also do a fee only style of investment advice where they don't actually take control of the assets, but they will make recommendations for the client and then charge like a consulting fee. And then that way there's no possibility of a Ponzi-like scheme or of them embezzling the money.
Yeah, what I found, what you have to be careful with that though is people that do that sometimes will do the investments anyway and say they make the statement that all they're going to do is the plan, but then they actually do offer the investments, and a lot of times those aren't investments that are performing on par. At least some of it, that's what I've seen locally. But some of it does come. Eventually, you have to figure out if you can trust somebody. And like in Bernie Madoff's case, I'm not sure how they were able to pull off the scam that they were able to pull off. In our case, the fact that we get so much documentation is not the only proof that you have, but you get documentation from each of the individual fund families. If it's we basically don't do the individual investments. Like, we are not a mutual fund company. We're hiring fund managers or insurance companies or investment companies to do the work of the investing. And our broker-dealer helps us do diligence on the companies that are available to work with. When you're in like a hedge fund or which is like a privately managed non-supervised or more lightly regulated investment type of company, you're relying on one person. I think you're much more vulnerable to that when they don't have a lot of regulatory oversight. So I don't know if that helps, but I'd be careful of hedge funds. Hedge funds were pretty popular among the rich for a while, or the wealthy for a while. Hedge fund returns are dramatically underperforming during this last uptick, and probably a third of them went out of business just in the last couple of years as the equity markets have performed well. That doesn't mean the hedge funds perform well in downturn markets. It depends on the hedge fund, depends on the manager, depending on what they're investing in. But I think the average person is better off in something that's more highly regulated or more closely regulated than an individual who's going out and buying, whatever businesses or a certain asset class. So I don't know if that answers your question.
It sure does. It's very helpful because when you talk with friends and, of course, those infamous relatives that are very paranoid about things, and they say, they say on one program that, you can put your money with us and you'll never risk any money going down, and it can only go up. And things like that, I think, make people wary about as far as what the opportunities and the idea of looking at an entire investment rather than a portion.
Yeah, and it sounds trite that if it sounds too good to be true, it probably is. There's a lot of validity to that statement because when people, like a lot of times, the equity index annuity people, the people that only sell equity index annuities are a good example. They'll use a lot of examples of, if that's the only product that they sell, they'll give you a lot of examples of why that should be your only investment. That shouldn't be your only investment, just like your only investment shouldn't be all cash, shouldn't be all equities, shouldn't be all bonds. You should have a mix in your portfolio that broadens your diversification across different things going up and down, because every bond markets go down, CDs may not go down. In fact, that's going to be what we're going to start to cover next, maybe the next show, is each asset class has its risk. In cash, while you see the value of your fund or your value of your cash stay the same, if inflation's 3% and you're getting 1%, which is what you're getting in cash right now, you're losing 2% to inflation every day. In 20 years, you've lost 40% of your purchasing power. So your $100,000 may buy $60,000 worth of stuff. Is that really what you want? Even though you can see your dollar value stay the same, or relatively the same as you go through time. But every asset class has its risk. If anybody's telling you this is the only thing you should be in, it's probably incorrect. That's why I think it's difficult to have three different people. Let's say you have one person that manages an equity, one that an insurance product of some kind, of an equity index annuity, a variable annuity, one that manages your equities, one that manages your cash or your safety net. A bank is a repository for it, but I wouldn't use an advisor to manage your cash from a bank if they're, they have investment managers. But you should have one financial plan, probably one advisor. Otherwise, you're getting conflicting views. The annuity guy is going to say all your money should be in the annuity. The equity guy is going to say everybody should be in the markets. The cash guy is going to say everything should be in cash or some kind of cash product, CDs, whatever. You should have a diversified portfolio with different things, different sources of money, and potentially different goals that you're trying to satisfy within your overall financial plan. Is that okay, Tom?
Thank you, and that's been very helpful.
Okay, and then hang on, and Art will grab your information, and we'll go to a break. This is Dave Weaver and Tom Pop with User Friendly Finance. Risk. Oh, boy. And the markets definitely go up and down every day. This is Dave Weaver and Tom Pop from SWC True North Wealth Management, and we're talking about our 8 wealth management issues and the subject of investment management. Wanted to mention again that we have 2 offices. We're located in Palmyra and Carlisle. In Palmyra, we're at 103 West Main. In Carlisle, we're at 35 East High. Both are about a block off the square. And actually, in Palmyra, we're a block west of the square, and in Carlisle, we're a block east of the square. So, but both very easy to find. You can reach us by phone at 717-706-0700, or you can reach us via the web at swcwealth.com. We really do try to get to every call within 24 hours, or every email within 24 hours if we possibly can. We're still in the throes of redesigning our website. New target, I don't know. We're still having issues getting asterisks, et cetera, through compliance. And I think we're down to the
we're making progress.
Nitty-bitty nuts and bolts, but hopefully by the end of the month we'll have our website designed the way we want it to look.
They have a nice photo of our team on there now.
Yeah, we do have a nice photo of our team. We would be the good-looking ones, right? No. We would be the faces for radio.
Yes,
that's the way you can tell Tom and I. Boy. So we're talking about the subject of risk and risk in your portfolio, how you manage that. And the caller did have a good question about when you're talking about investment risk. The one thing I like to point out is that not anybody can do investment management, but there's a lot of different ways to do investment management. You want to find somebody that you trust, you have confidence in. It is a good question. How do you know that the person you're dealing with isn't taking advantage of you or not trustworthy? I would do some research on their, like Tom said, on their broker-dealer, try to get some additional information on them. In our case, all the investments that we have are held through a clearing company called, right now it's First Clearing. We're going to be moving to another clearing company called NFS. That company does the record keeping. You should be receiving, if not by paper, electronically, prospectus for every fund that you're in, and you should be in more than one. Like in the case of Palmyra, a 2% CD. Nobody lumps all their clients together really and puts them in one CD or investment product.
Yeah, I think what the caller said about guaranteed,
guaranteed everything.
That's just a red flag.
Yeah, we're not allowed to say the word guaranteed. No. I don't think.
We'll probably edit that from the show.
Yeah. It's probably going to be. It's something that you shouldn't see in your in general in the language. There are some insurance products that do provide a level of guarantee in their annuity products, but that's something that's specific to a type of rider with a specific insurance product. It's not, particularly when you're talking about stock or bond investments, that's not you can't guarantee those returns because they're subject to the markets.
Yeah, it's a guarantee of return. And then, with risk as well, I don't think there is anything that is guaranteed in this world of investing that is going to be risk-free.
Yeah, totally.
If you look at it, risk is kind of like matter. You can't destroy it. Mm-hmm. It's always going to be there. You can push it around and, dilute it a little bit here and there, but it's going to exist, whether it be interest rate risk or market volatility risk or purchasing power risk. It's all there.
Yeah, we talk sometimes about the continuum of risk, and you start with, and every asset class has its own type of risk associated with it. But if you start with just typical investment vehicles, you start with a savings bond or savings account. You get a very low rate of return. Your principal stays about the same, but it's not that doesn't have risk. Like we talked about a second ago, you have risk of inflation. So the money that you if you're investing in a savings account, and this is true regardless of whether the market's up or down, you'll see your account go up You're always getting a rate that's lower than inflation. You're always going to be losing ground to inflation, and your principal stays the same, but you're losing purchasing power over time. But you go from savings accounts to CDs. CDs, you'll get a slightly higher return, some penalty for pulling your money out ahead of time. But again, you're losing accessibility to your money by getting a slightly higher rate of return you get in the savings account. Then you move to a fixed annuity where you're getting a higher return than a savings account or CD, and the insurance company is guaranteeing the rate, but they're guaranteeing it on the good faith of their ability to pay you the money back because you're lending them money with a fixed annuity.
And you have liquidity risk.
Yeah, you have
You
liquidity
have
risk.
surrender periods,
Right.
and you can't take all your money out.
So then as you move up that continuum, then you move to the various bond categories, and the bond categories are fluid, but they have investment risk, they have risk of the market,
interest rate risk.
all those things but you get a higher return because you're taking on more risk. Then you get into the equity world, and there's a whole slew of a continuum of risk up the equity world. So all these things have different levels of risk as you go through time, and the more somebody else takes on your behalf, the lower your return is going to be. So the bank is taking on all the risk for you of the rate going up or down, but they've also totally limited your risk. They're paying you less than 1% or 1% or less, whatever the rate order that is, up to 1%, maybe a little bit more right now. But they're also taking that money and lending it out for 5 to 7 or 8% or 10%, depending on how they're lending it out. There's always somebody profiting from this stuff. So we have another call on line 1. This is Donna from Lancaster. Hello, Donna. How are you today?
I'm fine. How are you?
We're just dandy.
Yeah, with all this rain, we feel like we're in a flood.
We are. Hopefully that's not coming. We don't need a flood.
No, we don't. But I thank you for your show anyway.
Sure. How can I help today?
Okay, I have a question about mutual funds, actually.
Okay.
In an IRA, and if there's a load or no load, do they still charge you for selling in that fund if you're in that fund?
An IRA is really just a term that the IRS use for the rules that have to do with individual retirement accounts. And you can hold an IRA in a whole myriad of different investment vehicles. You can have mutual funds, you can have annuities, variable annuities, equity equity index annuities, CDs. If you have an IRA that's in a traditional retail account held with a mutual fund company, there probably is not a sales charge to sell it.
Typically not, but it depends on what share class you're in.
Yeah, it depends what share class you're in. There are A shares, B shares, and C shares when you're talking in the retail world. And if you have an A share, you paid an upfront sales charge and don't pay anything when you sell the fund in the back. If you have a B share, there's no sales charge if you wait more than 4 years to sell it. It depends on the fund family, but typically you hold an A share for 5 years or more, then a B share from 2 to 5 years, and a C share for 1 to 2 years. A C share, you don't pay an upfront sales charge, but you pay 1% if you sell within the first year. A B share, no upfront sales charge, but a back-end sales charge if you sell within the first 3 years. None of those have a ticket charge, but they potentially, B and C shares potentially have a back-end sales charge. If you have like a managed investment account, typically that you don't pay an upfront sales charge, you don't pay a sales charge when you sell it. You're paying a management fee going through time, and you don't get charged anything when you sell the fund. So I don't know if is it a mutual fund that's held directly with a mutual fund company, or is it in a brokerage account?
Yeah, it's in a brokerage account.
Yeah, so if you are in a brokerage account, the A, B, and C share rules apply if it's an A, B, or C share for a mutual fund with a mutual fund company. If it's a managed account, then that has the rules of the managed account. But if it's a B, or C share class, then it would follow the same rules of A, B, and C that we just talked about.
Okay.
And usually it'll say, like, let's say it's Oppenheimer, whatever fund, it'll say Oppenheimer Main Street A, or Oppenheimer Main Street B, or the institutional shares, which are typically used in a managed account, might be like an I or a Y or some other letter than A, B, or C.
Okay.
If that helps.
Yes, it does. Yes, it does. I appreciate your help. Yeah.
Sure.
I have more insight now.
Okay. Well, Art will grab your information, and we'll send you the gift card. And thanks for listening. And I guess we're almost ready. Art, I guess I have to do that. Okay. There we go. Okay, and we're going to go back to the subject of risk just a little bit. Again, evaluate risk in your portfolio now. Don't change it because of the market. Markets go up and down every day. It's just something that you want to keep in your mind as you're doing mutual fund investments. The markets go up and down every day. So don't be panicked with the market. Just assume that it's going to go up and down. Have a portfolio that will last you based on your risk tolerance and time horizon. Don't change it unless something changes in your personal situation. Call us during the week, 717-706-0700, or via the web at swcwealth.com.
David Weaver, Megan Wall, and Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm.